Hello, Matt. How's it going today?
Hey, good. Thanks, Emmet. How are you doing?
Good, good. Looking forward to this chat today, our weekly episode of the Tuesday live streams. I'm kind of enjoying this. It's kind of fun just to once a week kind of open source our dialogue about how we're thinking about things and take some questions from people who are interested to pick our brains on things. How do you think it's going so far?
Yeah, I think it's good. I think the feedback seems pretty positive overall so far, aside from maybe some lighting and audio issues that we've had over time. But and
Yeah,
you and I have been having these conversations probably twice a week for, I don't know, 6 months or so now. And I think it's good to, like you said, open source the dialogue a little bit, let people kind of hear what we're thinking, and then also just hear what's on other folks' mind. I think it's the interactive part of the Q&A really, I think, is pretty helpful for me, just to kind of see where the temperature of a lot of listeners are.
yeah, it
What's your
certainly
thought?
helps us. I think the interactive Q&A helps us digest how we think about things, brings new questions to light that we might not have thought of. And as I've said before, I think questions are more important than answers. And I'm always trying to search for new questions to ask, and hearing other people's questions helps me think about things differently. And I think it's good for all of us. So, yeah. So, with the macro market kind of news going on, that's what we usually start with. I mean, the market really took a big hit yesterday. It seemed to coincide with this big Facebook whistleblower report. Was apparently 60 Minutes did a hit piece on it that aired Sunday night, and it seems like the headlines kind of tried to match it together. Like, hey, this caused uncertainty and jitters in the market, which crashed the market and social media stocks. And I don't know. It's hard to tell if there's like really truth to that, or if even if there was not a Facebook report like published Sunday night into Monday that the market would not have gone down like it did. I mean, what do you think? Do you think those things are correlated, or do you think it's just kind of happenstance in this case?
It's really hard to parse together, what is the actual driving force behind any given day's movement. I
Yeah,
mean, certainly that 60-minute hit piece did, I think, coincide with the decline in markets. I was actually looking at the futures on Sunday night, and they started off mildly green and then just went down pretty sharply. So kind of right when that 60 minutes piece was going on. So it's I think that certainly didn't help the situation at
yeah,
all, from the
yeah,
market standpoint. But there's also concerns about interest rates, which we talked about last week, and I think all growth stocks in particular, or growth stocks relative to the rest of the market, really got hammered yesterday. Tesla was resilient on the back of a strong earnings or a delivery report. But I always hesitate to ascribe one individual factor as driving any macro market movement like that. But
yeah.
yeah, they certainly didn't help.
Yeah, I mean, it's funny. The news media, they need some kind of strong link for people to connect a narrative to be able to click on their clicks, and just people, we hate uncertainty, we hate no non-explanations, and we need something to make sense. It's just our psychology. And so, I do also think, like, maybe there was some kind of self-fulfilling prophecy with some people panic selling some social media stocks, whether it's Twitter or Snap, as well as Facebook. But I think the market was probably due for a down day anyway. Probably also based on some of the Asian market activity the night
Yeah.
before I saw and such. So, it's one of those things like noise from signal. If I'm not thinking like about it, if I don't have the awareness, I might otherwise just assume whatever the media is telling me and be like, oh, and tell people, yeah, the market was down because Facebook got in trouble or whatever, and I don't think that's necessarily the case. But
So what did you think though of that? I mean, it seemed like it was obviously a pretty damning report that came out, although a lot of it I think wasn't necessarily news. I mean, this
yeah,
whistleblower leak that's been going on has been, I think, public knowledge for some time, that Facebook is essentially just turning a blind eye to a lot of these issues,
yeah,
knowing that they do have damaging
yeah,
effects, in particular to teen girls on Instagram.
yeah.
But I don't know, what was your takeaway? And then on the back of that, the outage on Monday, which Facebook said, is, no malicious intent here or something. They said something like that today. And I was like,
Just a
the
coincidence,
timing of
maybe.
that seems very
Yeah,
odd, to have like a
yeah,
pretty significant failure on the back of that 60 Minutes report. That just, to me, I don't really buy it. It seems like there's something malicious
yeah.
with
There's some
that.
connection on that, I think. Yeah, like maybe someone's trying to really tank I don't know, some hackers, whether it's anonymous, some other group is trying to mess with Facebook after that. I don't know. But yeah, I mean, the Instagram is clearly not a healthy uh, exposure for most people, I would say. But it's not Facebook's fault. I don't think. I don't attribute it personally to Facebook. Like if Facebook's not doing it, someone else will. Whether it's TikTok or Snap or someone else is gonna. It's just human psychology is drawn to the service they're providing, and someone's going to produce that service if it's not Instagram and Facebook. So I mean, could they do better with how they monitor it? Or of course, yeah, of course they could always do better. But there's something deeper here, a deeper kind of dilemma. China is tackling it in one way, I feel like, with their gaming, limiting the amount of gaming kids can do under 18 per week.
Yeah.
So they're being pretty strict about it. And maybe that's the best path. Maybe we find out later, like what China did was the best path. And the freedom of giving too much freedom to people in this kind of new internet age is a bad thing in some ways. And maybe we fast forward 20 years and we realize like a lot of US, are zombies sitting down watching Netflix all day and Instagram all day, not working. And China's like productive, building electric car vehicles and stuff. And I don't know, that's a possibility. So it's hard to say. I do like the idea of having freedom of being able to look whatever internet applications I want when I want, but parents have to have a responsibility to kind of monitor their kids, I think. And that's hard to do, though. It's easier said than done. And so, yeah,
Yeah,
it's
it's
a
a
dilemma.
it's a if you listen to a lot of parents who work in tech, though, a lot of them are I think leading the rest of the population in terms of putting restrictions on what their kids can do, which I think is kind of interesting. I mean, Steve Jobs famously, didn't want his kids having an iPhone, because it just sucks you in. And so as a parent, yeah, I'm very restrictive of what our kids can do. But I'm not sure that I really want the government necessarily doing it a la what China's doing.
Yeah.
So
No, I don't know
it's
either.
just,
Yeah, I'm not ready for that yet. I mean, but it's hard to say in the future. So, I mean, another point I was thinking of with the macro market movement and trying to connect it to news, like if the macro market was down again today, you'd see headlines saying like Elizabeth Warren's call to remove federal chairman Powell for insider trading is the cause of, jitters and risk. There's always some kind of grandstanding going on, or soapbox discussion by a political person or whatever it is. There's always something there that can be connected to a market down day on the news headlines. So you just don't know. The macro market is complex, and people who think they understand it, I think, are full of it for the most part. I mean, you can have thesis as to like where you think it's going, but to talk with like conviction and certainty is, in my mind, kind of a fool's errand. But
yeah, no, I agree with that point. And I think you're right. It's very easy to attach a narrative to an event, as a Monday morning quarterback, but yeah, now we've got a market update, and I think the narrative is just, okay, we're kind of recovering from yesterday's down day.
yeah,
But I think you're right. You can play a counterfactual and say, yeah, if it was a down day, then XYZ would be attached to whatever the narrative is. So I think it's important as investors not to get not to put too much weight into narratives, and instead just kind of focus on your own thesis. Because Tesla, it was up incredibly high yesterday. I think it touched 807, then retreated back on the kind of outperforming on a bad day, and now it's underperforming on a good day here on Tuesday. So it's it's very hard to kind of make too much sense of these very short-term movements.
Yeah. And I think in terms of like where the macro economy is going in general, it's uncertain with so many different countries. Unlike stocks, like you can have kind of conviction on a particular stock, like we do with Tesla, that it's going to execute well and the stock will eventually reflect the higher valuation and such. So moving to Tesla, I mean, they just reported 241,000 deliveries and I think 237,000 produced or something. So that's obviously a record quarter. It's going to be but by 20%, I think, sequentially to the amount of deliveries in the previous quarter. That's pretty impressive. So, I mean, that's huge. I mean, I think I put a poll out over the weekend. I'm uncertain to how the price would react. I want it to go up ridiculously high from that kind of surprise, and I think a lot of Tesla bulls want it, obviously think it should. But I have to take a step back and remember, like where we are in context as a market cap valuation already. And, Tesla's gone up 20x, I think, in the last like 2 years already, like 20 times, not like it hasn't doubled or tripled or quadrupled. It's gone up 20
Yeah.
times from like 2 years
Yep.
ago, 20 times. And so you see so many people. I went on Dave's chat interview the other night, and some people, I've read some comments, people like, Emmet doesn't understand that this is different from 2014 and 2019. Tesla's executing profitable. No, but Tesla's worth 20 times more than it was at 2014. Like, it's a big difference in the market cap valuation. I'm not sure people comprehend the 20x difference in market cap. Of course, they should be profitable. Of course, they should be doing everything they're doing now. And I hope it reflects a higher market cap in the stock sooner than later. I really do. But I hope to that from 2014 to 2019. And it took a long time to kind of get past that, 40 or 50 billion market cap range it was in. So I don't know. What do you think about the 241,000 deliveries and the stock price reaction right now? Do you have any thoughts, Matt?
Yeah, I was certainly surprised in a very good way. I was kind of thinking it'd be like 233. I don't know, 230 to 235 is kind of where I was thinking they'd be. So I was pretty surprised that they got to 241. Yeah, the stock moved kind of initially. It went up real close to 807, and 800 seemed like maybe a reasonable place of where it could be. But I think I tweeted out over the weekend that it wouldn't surprise me if it ended the day in the red anyways. Because it's just so hard to really put significant weight in any of these short-term releases. And now here we are. I think it closed Friday at 775, and we're pretty near that right now, even after outstanding news. So to me, I kind of expect the price will rise in the coming weeks heading into earnings, but you can never really tell.
Yeah, you can't tell. I mean, it's surprising to me already that, today's an up day. NASDAQ is back up, almost correcting for the loss yesterday, up almost 2% as I'm looking right now at my screen. And Tesla is negative, just barely. It was up earlier this morning, but it's come back down. So, yeah, I mean, it seems like anytime right now there's an opportunity to sell and, Tesla stock with some strength, there's institutions, lowering their weightings on Tesla, after such a big gain in the last 2 years. I mean, it's you can't argue with what the market's doing. I mean, you can say it should be higher, it should go up, but in reality, it's not. And eventually, it probably will. But whether it's, I think I mentioned something in the chat with Dave, like if in the next few months, from all the good news with like the factories coming online and full self-driving beta kind of advancing, if the next like few months don't show a stock breaking out of like above $1 trillion market cap, I think we're perhaps in this kind of $500 to $1,000 range for a long time. That's my thought, my inclination. So we'll have to see. I mean, it's 800 billion market cap. That's like a behemoth of a company, and I don't know. It's like way bigger than any other automaker. It's as big as like almost all the other automakers combined, basically. So I think the real big next leg up is when full self-driving is like mass adopted. It's so good that it's mass adopted. Margins are obviously much different. I think that's the most likely case for the stock to really get kind of re-rated to a multi-trillion market cap that I think many of us bulls believe it will be worth. So it just takes time.
I think that's a reasonable point of view. How much I love doing financial modeling, and I looking out forward a year, 2 years. I think there's a pretty strong case to be made that you can kind of justify the current valuation, maybe plus or minus $200, per share, just based on kind of forward earnings multiples, given a really high growth rate and the margins that they're able to handle. I mean, the fact that they're pumping out roughly 30% automotive gross margins, despite the fact that full self-driving is not fully recognizable, is just really impressive. So you just kind of project deliveries of 1 million, 2 million units in the next couple of years, and apply a PE to that, and I think you've got a very strong case for the current valuation. But yeah, in terms of kind of that revaluation up to the multi-trillion-dollar market cap, I think you do need that full self-driving kind of robo-taxi potential. Maybe it doesn't even need robo-taxis necessarily, but full self-driving having greater penetration would just completely transform the financials. So that's kind of like step one, and then step two would be if people believe there's a strong possibility for robo-taxis. So that's kind of how I think of movements. But I think you're right. I think if absent some significant movement on FSD, then probably range bound and plus or minus $200 from here.
Yeah, I mean the potential upside is if the macro market really cooperates, instead of kind of the tech stocks and growth stocks all being kind of flat, for which they've been for the last several months. If there's another tailwind that kicks all the growth stocks up, the tide will rise and Tesla will rise with it. That's kind of the caveat there. But also, if there's a major downturn correction in the growth tech stocks further, Tesla could take a little bit of a hit there too with it. So, there's always the macro market, what that's doing. That's sort of, the wind of the sails of, I don't know, the tide or whatever metaphor you want to bring to it, but it has an effect, obviously. So I think we're at the kind of the main event of this chat is kind of going over your, the model for the earnings per share we're projecting, and Matt, it's really your model you put together. And are you able to share your screen and kind of go over it here? Or?
Yeah, let me know. Can you see the model up now? All right, great. So I can't see you for some reason now, so I'll just walk through. Let me know if it's not showing up on the screen. All right, good. So yeah, this is the model. I've got the 4 most recent quarters with actual results in here in these columns. Q3 is my projection, so we'll kind of walk through some of the major changes quarter over quarter from Q2 and kind of what they mean. So I've updated this with the actual deliveries from the production and delivery report that we got over the weekend. So one of the big changes from Q3 to Q2 is just that you've got a significant amount of Model S being delivered this quarter. Those are obviously high margin vehicles, so that will, I think, go a long way toward improving the overall automotive gross margin. So not only do you have higher gross margins on those, but you're I think in Q3 or in Q2, you probably had some negative pressure because you were not amortizing some of the cost of the equipment over vehicles in Q2. So that should be a fairly decent boost. And then you've got I think a similar thing happening with the Model 3 and Y, where you've just got more output from the same factories. I mean, this is all obviously coming out of Fremont and Shanghai. So you've just got 33,000 more vehicles being produced, and all the overhead costs of the facilities and the depreciation expense. Some of it is depreciated on a per unit basis, but some of it is also depreciated over time. So no matter how you really cut it, you're going to have better margins just based on the fact that you've got more output coming from the same capital deployed. So that's certainly good news. One thing I think maybe a lot of people are not thinking about is the full self-driving take rate. So this is something that I estimate based on a lot of the releases that Tesla's had historically. We know that their take rate in China is very low. In Europe, it's low, but not quite as low in China as it is in China. And so I've been able to kind of piece together that this has been falling over the last several years. So in Q2, I estimated it was 18% on a global basis. I'm projecting a pretty significant drop in Q3 to 13%. And the real reason for that is, sure, you've got more units being shipped to Europe and China, which we know has a lower take rate. But I think the other thing which will impact take rate in the US is that you've got a subscription option now. So I do think there's going to be fewer people buying the purchase option outright. But to kind of make up for that, I've got this subscription option coming here. So I'm assuming 35,000 people will subscribe to FSD in Q3. So a relatively small percent. I mean, it's roughly 10% of the new deliveries. I don't know, that's not right. What is it? Mental math. Yeah, somewhere around there. Yeah, 15%. But it's not necessarily only new deliveries. You have to also keep in mind that existing vehicle owners who just didn't buy FSD could also, subscribe. So this is going to be a relatively small impact. You can see here, like subscriptions in Q3, I'm only expecting $20 million of revenue. But over time, this is just going to continue to accumulate. And so I think if you fast forward 3, 4, 5 years, where you'll have, just quarter after quarter of more people subscribing, I think it's eventually going to be a very big deal. But in the short term, it actually, I think, probably hurts Tesla's financials that they have this as an option. Let me finish walking through the model, and then I'll walk through a couple of charts that I have.
Okay.
Let's sorry, collect my thoughts here. The Fsd Cash Intake is actually decreasing a little bit sequentially. So if you think of the 18% take rate that I had in Q2 on a smaller base of units, that generated $490 million of cash coming into Tesla. Again, This is a bit of an estimate, and that's decreasing to $461 million in Q3, and that's just due to the lower take rate. This is not all recognized immediately, as we all know. So you got this, 42% that I've estimated that is actually deferred until probably in Q4. Most of that will be recognized. So there's going to be, $1.6 billion. That's my estimate of the current deferred revenue balance. So that's going to hit Tesla's financials, I think, sometime over the next, 12 months, but probably a big chunk of it in Q4. The amount that's in Europe and in China, that may take longer, but still, it's a huge amount, and it will flow through the financials and have a benefit at some point. But about half of the, so you got $268 million of GAAP earnings benefit this quarter, which again is down sequentially. I'm assuming $400 million of credits. That's kind of a middle of the road estimate in my mind. And then I've got a couple other smaller items here: acceleration boost and FSD subscriptions. So putting this all together, I'm at $13.8 billion of total revenue. I just grew the energy revenue by about 15% and the services revenue by the same. I might be high or low on those, but the margin is relatively small, so it probably won't move the needle too much. Then the big thing that I wanted to kind of talk about is the manufacturing margin that we talk about. So this is the what I call the core manufacturing gross margin. So how profitable are Tesla's core manufacturing facilities? So excluding full self-driving and any credit sales, how profitable is just the core operations? Bradford Ferguson has done a lot of work on this, kind of talking about quarter over quarter, what are all the benefits, like we mentioned, the Model S and the shift in Model Y production. Martin Viecha has talked about the Model Ys being exported to Europe from China being the most profitable vehicles. So that's going to be a boost. And I've tried to kind of piece all this together. I think optimistically, there's maybe like $1 billion of gross margin upside quarter over quarter, but I don't think it's necessarily going to be quite that high. So, we were at 2.9 last quarter. I'm at 3.75 this quarter. So there's a little bit of wiggle room potentially on the high end, but I also, I don't want to take credit for everything. I want kind of my estimate of a middle of the road gross margin that I think Tesla can achieve. So that's kind of what I've gone for here.
Yeah, 31.8% there, gross margin. That's pretty impressive.
So that would be the first time Tesla's had a gross margin that high. And I mean, honestly, if I were to go back, 2-3 years ago, I don't think anybody would have ever thought Tesla would achieve this level of profitability, let alone so soon. So people talk about Tesla's valuation being crazy, given the fact that they only sold 500,000 cars this year. But they're not only experiencing, over 50%, year over year growth, at least this year, but they have incredibly profitable, just kind of core operations. So they've really, we all know they have this minimalist design philosophy. They're deleting all sorts of parts that they don't think are necessary. And now that they're manufacturing at scale, you're seeing a lot of the benefits of that philosophy kind of flow through the financials. So yeah, it's impressive. I don't think they'll go back below 30% for the foreseeable future. Even in an environment where I'm expecting 5%, cost or price declines every year. And even with that, I do think that they're going to be able to kind of maintain these margins.
Yeah, and just to interrupt you for a second, I mean, that 30% gross margin plus number, which I think is very likely as well. We've 31.8% we're projecting this quarter. Maybe it's a little higher next quarter, or maybe it's the same or even lower as other factories come online. We
Yeah.
have to, but 30% plus on average over the next several quarters as volume increases. That's super impressive. And my natural mindset is to think, oh man, the stock's going to take off like crazy. And maybe if the stock hadn't gone up 20x in the last 2 years, that'd be definitely the case. But yeah, I mean, I'm just trying to put water on the fire of my excitement that the stock has increased 20 times in the last 2 years already in terms of market cap. And it's hard to know how much of this kind of growth and margins is built into that market cap right now. If the stock had been only gone up like 3x in the last 2 years, I'd say, oh yeah, this is, then it'd be much more likely it's going to go up another 3x or whatever.
Yeah.
But it's just it's hard to say because of the super big run up that it had already, and 800 billion market cap it has right now. But it's very exciting. I'm excited. I'm a long-term investor, and I still think by the end of the decade it'll be the biggest company in the world. But just as the next few quarters are going to be monstrous, I'm just throwing water on my excitement here. That the
Yeah.
stock might not go up to 2,000 or 1,500, like I think a lot of people probably feel
Yeah.
emotionally it will.
So I do somewhat agree with you. It's interesting though, because I was going back through my initial thesis from 2019 on what I predicted the stock was going to 2 to 4x at the end of but over the next 12, or basically over the course of 2020, because I made this model based kind of prediction in just like December of 2019. But my thesis there was that the FSD take rate was going to go up, and that you were going to have that be 100% recognizable basically by this point in time. And instead, what we've seen is that FSD take rate has decreased steadily over time, but Tesla's just core manufacturing efficiency has been way, way, way better than anyone expected. So from my point of view, I kind of agree with you that I don't know what the stock's going to do. But in the back of my mind, I have this initial thesis that I had is still intact, that FSD take rate can go from let's call it 15% today to 30, 35, 40% overall in the coming years. And if they do that on top of like a ridiculous just core manufacturing efficiency, I mean, it's not unthinkable to think that you could have 40+% automotive gross margins. And so in a scenario like that, there's just the numbers start to look silly, and so I do think there would have to be some sort of re-rating. But I like to follow the facts, and right now the facts are pointing to a declining FSD take rate. It's going to take time for that to turn around, and so that's why I'm very keen to kind of see how FSD progresses.
It's a good point.
So, going on to energy and services, there was frankly a surprising uptick in Q2. I'll just go over to the chart for this one because it probably makes it easier to see. So energy gross margin had been, right around zero historically. In Q1, it was really low. It was negative 11%. Q2, it rebounded drastically to 2.1%. So that kind of tells me that they really turned the corner in being able to monetize gross margins, probably on solar roof in particular, but also on their stationary storage deployments, which did increase a lot in Q2. So I've assumed a modest increase from 2.1% to 6% in Q3, and then essentially keeping services margin roughly the same at negative 2%. I tend to think they'll always run services at break even, but they do have a benefit of used car prices are continuing to be resilient overall, and for Teslas in particular. So I think that'll help a bit on that front. Anyway, kind of putting all that together, we get back to some overhead costs, which I have increasing sequentially. Stock-based compensation increasing again. This does include Elon's compensation package, but there's a lot of stock-based compensation for the rest of the employees as well. So even though he may have, I think, peaked in the amount of his SBC that is recognized in each quarter, I think that's going to decline from here. but the rest of the employees still do have that stock-based compensation. So I don't think the overall number is going to drop. Anyway, putting all that together, one other point to highlight: in Q2, there was a really low effective tax rate that Tesla saw. It was only 8.9%, I believe. So I've normalized that out to 25% in Q3. But putting that together, I'm at $1.83 in non-GAAP EPS. Last time I checked, the street average was around $1.40, somewhere in that neighborhood, $1.43 maybe it was. So there's a pretty big disconnect, I think, between where I am based on all the things that I'm putting together, and I think where the Wall Street analysts were. Those estimates, I'm sure, will continue to come up in the coming days and weeks, just as analysts rerun their models with the actual delivery figures. But in my mind, I mean, talking about Tesla's valuation, one thing I like to try to do is look at like the annualized PE ratio. So if you were to take this $1.83, multiply that by 4 quarters. Sorry, I can't see this now. So this will get you to like an annualized earnings rate. So then you take today's price, what is it, 780, and divide it by that annualized earnings per share. You're only at 107 on a PE. So to me, that's provides a relatively stable, level of support that if Tesla continues to execute in the way that they are, I think that's going to make it harder for the stock to fall back to, say, like 500 or 600, something in that range.
Yeah, if it went down to like 5, if it went to like 400, it'd have like a 50 PE pretty much. Next quarter, because the earnings will probably be $2 next quarter or something. So
exactly
50. And then it would just look kind of ridiculously cheap for such a fast growing stock. So I agree, there's a nice backstop for how low the stock can probably go as these earnings are increasing. That's good.
Yep. So just run through a couple of these charts quickly, because I think we've already touched on most of this, but you can just see how this deferred revenue balance has increased sequentially quarter over quarter. And if you just think of the fact that they're only recognizing roughly half of the Fsd revenue that they have right now, then every quarter in the future, not only will you have some amount of this recognition of deferred revenue, but you'll also have about $200 million, maybe more, of recognition on full self-driving that in the past would have been deferred. So that's a benefit that's going to be there that I think a lot of analysts are not actually modeling out properly. Then this is my estimate of that core manufacturing, how that gross margin, how that has increased over time. I think your point is right, that as Berlin and Austin come online this quarter probably, but over the coming quarters, that's probably going to apply a little bit of pressure to the gross margin. So going forward, I would expect that to drop a little bit, and then kind of recover as those plants get up to scale. And then you can see here, I think, we already touched on these for energy and services. So that's my model. That's where we are. I'll stop sharing now so I can get your face back in it. But
all right,
that's what I'm thinking right now.
Cool. Yeah, no, I think that's good. I'm always very impressed with the spreadsheet you're able to draw up, Matt, and you do a good job explaining it. So I guess, we'll just go to the Q&A portion of today. I think from there, most people have questions about Tesla and such. So Alec, if you get a chance, would you mind putting up the questions? All right, here we go. So the first question is from Hypermind Intera on Twitter. Given Tesla has close to 1 million EVs on the road, I think they have like 2 million, maybe close to 2 million, right? I don't know.
They're definitely over 1 million.
Yeah. How much additional revenue could Tesla add if it achieved level 5 autonomy? I mean, a ridiculous amount of extra revenue with 2 million EV. I mean, it just goes up. Like, the cars are worth a lot more. ARC's done a lot of investment on this. Research on this, and they put it out there on GitHub and such for people to kind of see their models with that. Matt, what do you think?
Yeah, I'm just pulling up. So I did a detailed model that kind of did that included some robotaxi profitability estimates. trying to see, what I had in there. So just assuming that they were able to launch that service like in 2024, at that point they'd have even more, robotaxis on the road. Let me see what my model says at that point.
Sure.
So at that point, so in calendar 2024, my model estimated over $13 billion of robotaxi revenue. And I won't walk through all the assumptions in there, but that's very high margin revenue. So you can, maybe for the sake of argument, you could just call it, $10 billion in operating income, which most of that would kind of flow through to pre-tax income. Then you tax affect that. So it'd be huge. So that's maybe we'll do another one of these sessions at some point in the future to kind of go over that model that I have, which is kind of more detailed on that hypothetical part of the business. But yeah, it would be huge, and it would just grow over time. So not only, we've talked about this, I think, in the past before, where you've got right now your automotive deliveries are growing exponentially, but with robo taxis, they're not only is your fleet growing exponentially, but your revenue would actually grow cumulatively on an exponential growth pattern. So every new robo taxi that you build and put into the fleet gets added to the previous quarter's total. So then you've got this just kind of ridiculous pie of assets that you monetize at the point of sale when you initially sell them to a customer, and then you continue to monetize over the life of the vehicle. So it could be just like crazy profitable.
Next question from Above the Fog on Twitter. On the last chat with Dave, you talked about book runners having methods to prop up prices after IPO. How does this work? That's a great question. I remember studying for the 7, and I think it was the 54 and some other one, several of these tests I studied for, and I remember learning about how the whole book runner process works. And then I actually, years ago at UBS Investment Bank, I worked on the trading floor, but I was good friends with some of the guys in the capital markets team and understood a little bit of their processes. And I've just pieced things together. I don't know all the details, but if you think about it, it makes perfect sense. I haven't worked in the capital market side of, mechanical trading operation, IPO listing aspects of investment banks that are these book runners. But if they're selling these deals to their institutional clients, their top tier clients, to get in an IPO, these investment banks make a killing on it. That's like one of the most profitable. I know that's like their most profitable division is these capital markets, these IPOs, and they need to keep that business thriving by making their clients happy. And their clients are not happy if they buy into the IPO and the stock goes down, right? And so these book runners, they often get an allocation themselves as part of the deal. And somehow they use that, I believe, to help. Maybe they buy up some on their own proprietary books ahead of time, or I don't know what they do exactly, but they have some mechanisms in place to kind of help boost, not inflate the price necessarily, but to kind of keep it from going below this IPO listing price. It makes it very difficult. So, and a lot of these institutional clients that they sell to, they kind of want to have like a handshake agreement that these institutional clients aren't going to just flip the trade immediately either, because the clients of theirs that do flip the trade once they get the IPO on the first day, they often stop giving those types of deals to. So, there's a lot of processes in place to make the IPOs, the price stable, at least, if not successful, in terms of like the price going higher than the IPO listing price and staying higher. So that's what I know. I don't know the exact details of how it all works, but it's certainly in my mind. I'm pretty highly convicted in those incentive structures to go like that. Next question, Dan Mac 51 on Twitter. How is Tesla handling the chip shortage better than all others? Is Tesla constrained by chips at all? You want to take a stab on that, Matt?
Yeah. So Elon obviously addressed this in the Q2. I think it was the Q2 earnings call. Maybe it was Q1 even. But basically saying, they were coming up with technical solutions where if they didn't have a chip for a certain function, they would use a replacement product and kind of rewrite the software to do the same function that the chip would normally do. So they're kind of coming up with creative solutions like that. I think the other thing they've been able to do really since the start of the pandemic, they were aggressive in trying to keep their order flow high. I think a lot of, you think back to Q1, Q2 of last year, a lot of people thought the sky was falling, and automakers were shutting down plants and canceling orders, and Tesla was keeping the pressure up. They say, no, we need all the chips we can get. You see the comments. I think it was with the CEO of NVIDIA saying, Tesla's been great to work with. So I think they're probably getting preferential treatment from chip suppliers relative to automakers who kind of canceled orders proactively, and then now are scrambling to get that supply back in. So I think that's those are a couple factors that are at play. But Elon also tweeted over the weekend that basically it was extremely hard to get all these chips that they need. So it's very easy to just say, oh, Tesla's a better company and they're just better at handling these. And that's true, but it doesn't mean that it's easy. I think all these kind of victories that Tesla has and being able to keep up this crazy growth rate, it's hard, and they've got just incredibly talented people, not just Elon, that are working there.
Yeah, it speaks volumes to their vertical integration and allows them to be more nimble than legacy automakers by a long shot, I'd say.
Yep.
From Callie Kayaker on Twitter, why do you think most hedge funds tend to lag the S&P 500? Will Tesla growth outperform index over the next decade? I mean, yeah, it's a great question. Most people don't outperform the S&P 500. It's sort of like this first part of the question, I would say, sort of like the law of averages, I would think. Hedge funds are, whether they're buying and selling and trading, or they're using leverage or shorting stocks, there's fees they're paying to the brokers, who are the middlemen, sort of like the house of the casino, and while the odds are in the favor of the gambler with respect to the stock market, going up 8% per year on average, I think, over the long run or something like that. That 8% per year is if you just buy and hold the index, right? But if you're kind of mixing and matching different stocks, and there's thousands of hedge funds doing this, they can't all be right. Some of them are, most of them, some of them are, some aren't. But then you add in the costs, you layer in the cost to them for going long, short, the borrow fees, the takes that the brokers take on that, the commissions and such. Then that, I think, drags on their performance over the long term, especially. And so, yeah, you have some hedge funds that do outperform the S&P 500, but over 50%, I would say, in any given year are probably not going to outperform the S&P 500. That's my feeling. And I think statistically, there's all kinds of reports that show the vast majority over the long run, do not outperform the S&P 500. It's very hard to outperform it over a long period of time. Matt, what do you want to add anything or take on that second part of the question?
Yeah, the only thing I want to really add on that is on that second part of the question. It's actually a comment that I think you had at one point, Emmet, saying, I forget exactly how you worded it, but that there could be kind of a new golden era for the stock market, just with kind of crazy economic growth and some of these huge disruptions like in AI that we're seeing. It's almost a bit of a trope at this point, but I think that old phrase, software is eating the world, I think that's true. You're just seeing crazy efficiency gains. If you look at some of the stuff coming out of the OpenAI and that GPT-3, that's like, if you just think of how much more efficient that can make an average coder's workflow, if they don't have to do every single bit of code themselves, they can rely on some sort of augmentation to help them with their code. And you think of all the different ways where things that are done right now by a team of people, like accounting, or like even to some degree some of the finance stuff that I used to do in my own job. I think all these things right now, which we think of as always needing a human to do, there's going to be software that can do that better, faster, cheaper, with fewer errors. And so I think there's you're going to have better applications of AI in the future, and you're going to have continued kind of development of it. And so I think that there's going to be higher economic growth in the next 10 years, GDP growth enabled by all these efficiencies in software than we have had, historically over the last 100 years. So I don't necessarily think that the way that I was taught finance in college, where you just take the average of the stock market return from 1923 or whatever it was to the present day, it works out to 7%, and that's what you use to assume going forward. I think that's a flawed assumption. But it's what the finance community uses, and so I think that creates opportunities to kind of outperform going forward.
Yeah, I'd agree with that. Next question from Ted Ra. Any chance we could reach over 900,000 deliveries for 2021? I actually do think there's a chance. I think, I think we'll know more in a couple of days after the annual meeting, Giga Berlin. Giga Austin. But I would say there's probably, in my mind, a decent chance that at this Giga Austin annual meeting, there's going to be some kind of reveal or announcement of hey, production's up and running. We're producing 1,000 cars a week right now already, and we're going to be at 2,000 cars a week by the end of the month and 4,000 cars a week by the end of the year or something, And so if you add that in and you times it with Berlin too, maybe it's the same kind of thing going on at Berlin, then I think, 900,000 is certainly on the table. I don't know. Do you have any thoughts, Matt? But it's a big if, depending on what happens in a couple of days. But what do you think, Matt?
I agree with you. It's they're, I think, roughly at maybe 250,000 per unit or so per quarter run rate right now. So that puts them certainly within spitting distance of 900,000. So if they can get a few 10,000 vehicles each out of Austin and Berlin, then they can get there. So. And you've got events at both. You've got the shareholder event out of Austin, interestingly, this week, and then you've got the Berlin event. What is that, next week? I think. Where they're doing
2 days after.
So we've always kind of known that right around now is when those facilities would be launching, and there was some report on, I think it was on the Tesla Motors Club forum, that somebody said that the Model Ys are already being produced in large numbers out of Austin. I don't know that I believe that necessarily, but it could be true. So I think it's certainly possible, and I'm curious to see what happens.
One thing I know Elon likes these special round numbers, 420, 69 million, he likes, who doesn't, right? So do you think if there's any, if there is some kind of, if they have been working on getting Giga, Austin up and running and announce it in a couple of days, hey, we're running 1,000 a week run rate right now, and we're going to ramp up as fast as we can. And Giga Berlin, same kind of thing. I don't know. I'm just thinking in my head, I haven't done the back of the napkin math for what the rates would have to be, but to get to 1 million this year, small chance. I don't think it's going to happen, but if they could potentially get to 950,000, I would say Elon's going to push the limit as much as possible to get to that 1 million. If they're in spitting distance, you said spitting distance. I was like, man, if they're in spitting distance of 1 million somehow, Elon's going to raise everything he can to make it happen, because I think in his mind, getting to that 1 million, there would be nothing better than get to 1 million cars this year. I know he talked about
100% year-over-year growth. That's crazy.
Crazy. I would put the odds at 5% chance, but I'm not. It's not impossible. There's a chance that maybe if Austin and Berlin are ready to just go, start producing and ramping up to a couple thousand a week in the middle of the quarter or whatever. And
I think it'd have to be at a couple thousand a week, which is an aggressive target, because they
have to each produce 50,000 cars at least, each of those factories. You think, right?
So let's say it's over 10 weeks of the quarter. So
Shanghai's ramped up so fast. Shanghai, maybe that'll produce, what they produced last quarter, 125 or 135 or something. Maybe they produce 150 this quarter.
Exact number, but Shanghai, it's a good point in that I think that will certainly continue to ramp. If nothing else, whatever they saw in September will probably be normalized over the full 3 months of Q4. So maybe you get a little help there. Fremont, maybe you get a couple Model X out of there.
I think it would be so painful for Elon if somehow they did so well. They got 960,000, 980,000, but they couldn't crash that 1 million mark.
The funny thing though is looking back, what was it, end of last year? I think they guided for, at least 50% in 2020, and now they're like blowing way past that, and still
Yeah.
nobody's really like giving them credit for what they've done so far.
Yeah.
It's kind of like, because I remember the commentary was then, oh, he was targeting like 1 million units per year, and now they're just saying 50%, and so they're only going to do 750,000 in 2021, and demand is falling.
Yeah.
And there's all these crazy narratives out there. And now they're just
Yeah.
silently kind of blowing expectations like quarter after quarter, and it's
Yeah.
great to see them actually just executing like this. But I would be genuinely shocked if they get to 1 million, but it's not impossible.
Yeah. Let's go to the next question here. Does Goodsoil have a plan from Aaron L? Does Goodsoil have a plan to open up to smaller investors in the future? Yeah, I mean, at some point, we'd love to have an ETF set up. We've talked about that before. We turned down a ton of people, unfortunately. Our fund is high risk and we have a high minimum. And so we're focusing on just trying to have our performance well enough where, it sustains itself and contributes to the foundation and such and so forth. And we, at some point we would love to set up an ETF. I mean, you can't be quite as aggressive in the ETF in terms of options. It's much more difficult to, run options within an ETF. Not impossible, but much harder. So it'd more likely be, a long only or long short ETF or something like that that's actively managed. But we would like to, have that at some point. It's just not in the cards this year, possibly next year or the year after, but probably not in the next couple quarters. There's a little bit of work that goes into that.
Yeah, regulations are harder to do that. So we have some work to do on our end to launch something like that.
Yeah. From Andrew Gabriel, can Canadians invest with Goodsoil? That's a good question. I believe Canadians can, because it's a hedge fund. So yeah, if you email us at info@goodsoilinvestment.com, we can get more info on that. But I believe that question came up once before, and the answer is yes.
Yeah, I mean, we have a fair amount of international investors from a lot of different countries, so it's certainly. I don't think there'd be anything special about Canada that would preclude.
Well, Canada is a little special, actually, from a regulatory perspective. Their regulators are very strict. I know that from my previous job. Like, it's kind of crazy over. It's like Cuba or something. I don't know the regulations around financial investing. But I think because our hedge fund isn't registered or something, maybe it's okay. But yeah, Japan and Canada are two countries that are kind of strict. I know. From Adrian Sayan's question: where do you speculate the next gigafactory will be? Any thoughts, Matt?
Yeah, I do hesitate to speculate a little bit. I think Elon talked about East Coast, and there's been speculation on UK. There's also been speculation on India. I'm not really sure, to be honest with you.
Yeah,
it's not clear to me, where demand is going to be saturated. Like once Berlin and Austin are fully ramped, will they be able to fully meet U.S. demand and European demand? If they can't, then maybe you launch another one in one of those countries, and if not, maybe you go to India and launch the 25K version there, or something like that.
Yeah, it seems like they're in talks in India. Not long ago, there was like rumors of Indonesia or something. I don't know. That was like a year or a while back, but somewhere else in Asia, maybe another one in China. Could be the UK. I know there's a lot of engineering talent there. Elon's attracted to, I think, and other parts. Maybe Russia was like a rumor or something. I don't know, but Elon sort of denied it. But who knows? Anything's possible, I guess, with the way Elon does things. From Alex B, if Tesla credit rating increased, what kind of new buyers can it bring in, and how big the demand could be for the stock? Yeah, I mean, I see that as a nice marginal win. I'm not an expert on credit rating impacts of growth stocks or tech stocks, especially. I mean, I think it would be a nice feather in the cap for Tesla. That's my initial thought. Like, it would help. It wouldn't be anything like the S&P inclusion, where a ton of index funds were forced to buy a certain amount of shares by X date, and then a lot of pressure was put on all the closet indexers out there who, basically benchmark the S&P 500 for their trading. So it wouldn't be anything close to that in my mind, but I think it would certainly be a tailwind to help to some degree. Matt, you have any thoughts on investment credit ratings and how that might change?
I agree. I think it'd be a slight benefit. You may have some institutions which have some restrictions on what equities they can invest in based on the implied riskiness of their debt ratings. But I don't think maybe it's a couple percent boost to the stock price, but I think it'll be a relatively small catalyst. To me, it's just crazy and shows you how backward looking these rating agencies are, that I think Tesla's cash balance, I believe right now it definitely is bigger than the total outstanding debt. So it's just crazy. And, they list things like, the questioning the sustainability of Tesla's margins or something like that. And it's like, I don't have a whole lot of respect for the rating agencies, because they don't seem to fulfill their stated role, which is to kind of like predict defaults. In very I guess foreseeable situations they do that, but generally speaking, they're a lagging indicator when they're supposed to be a leading indicator.
Yeah. Maybe we'll make this the last question. We're probably at the 1 hour mark here. So from Dream Coding on Twitter, it says, do a mega bull case for 2040 with robotaxi, freight fleet, global energy as a service, eVTOL, Tesla fleet, and the Tesla bot labor. How that's going to displace the labor market. I mean, 2040, that's 20 years. That's a long time. I mean, to me, that's like envisioning what's going on today with Tesla back in 1990, or Apple, or even, imagine back in 1990, 30 years ago, trying to imagine what life is like today. And even though 20 years is not 30 years, I think things are accelerating where 20 years, maybe 15 years will be like 30 years of progress in the previous 30 years even. Yeah. So 20 years out, 2040 is just unimaginable. I mean, all those things that are mentioned in this question, robotaxi, freight fleet, global energy as a service, eVTOL fleet, and Tesla bot, those are all in play, but there's even going to be more things in play that we can't even imagine right now. That'll probably be unveiled in a few years or 10 years even, and it's just unimaginable. I can only think a few years, like 5, maybe 10 years out if I'm, if I feel confident, but I'm probably way off the farther out I go. But 20 years, it's very hard. I mean, there's a substantial chance human civilization destroys itself in the next 20 years, to be honest. It's sad. I don't mean to put a damper on this whole thing, but, it's going to be crazy. Hopefully that doesn't happen. But yeah, 20 years is just so unimaginable. There's going to be some black swan events between now and then, I'm sure. Any thoughts, Matt? I don't know.
Yeah, I mean, I do agree with you. I mean, you can basically just look at some of Warren Redlick's predictions, and it's, some of them look kind of crazy, but it's not completely crazy. Like, you think of how disruptive each one of these units are, and especially by 2040, with my background in energy, I do believe kind of the current model for electricity generation, transmission, and distribution is going to be disrupted in the 2030s, not in the 2020s. But it's just going to make so much more economic sense to have small distributed solar with backup batteries than it is to pay for the crazy power plants that are more expensive than solar, and then you're basically paying for more than the cost of generation just to get the electrons to the place where they need to be consumed. So that's a model that's ripe for disruption. So I think that's going to make the energy piece huge by 2040. Robotaxis, I do believe, will be huge by 2040. eVTOL, I don't know. Seems like it could be great. And then the bot, yeah, I think that could be huge as well. But I think there's a lot of learning that needs to happen for that. I think it's probably going to be a harder problem than I think a lot of people are giving it credit for right now. But they've got the right infrastructure, I think, to handle a problem like that. So yeah, I don't know, just add a couple zeros on the stock price, and that's the ultra bull case, I guess.
Yeah. I mean, I'm very, the best stock to be in for 2040 in my mind is Tesla. But I mean, we'll see. I mean, So coming up, we've been putting some interviews on. We had a good interview with Chuck Cook that was pretty popular. We had an interview with an old friend of mine, Dimitri, last week that, just going reminiscing over old times of investing in Tesla early on 10 years ago and such. And now we have an interview coming up on the opposite end of, instead of a echo chamber bull chat, we have an interview with sort of a skeptic. He's been a bull in the past, I think, and he's sort of a skeptic, as well at times. Taylor Ogan, right, Matt, in a couple days, and we'll release that probably in a few days. And then we also have Yashu from the YouTube channel Hit That Bid. He's guest hosting with me. I think next week you're out, Matt. Is that right?
Yep. Yeah, I'm out next week.
Matt's out next week. So Yashu from Hit That Bid is going to kind of do the YouTube live stream with me next Tuesday. And I've asked him if he wants to help go over some of his technical analysis. I'm not a huge believer in technical analysis, but I know he uses those in his discussion. So maybe we can learn something from that. And we'll just take questions from people too and talk about, do the normal thing that Matt and I do, but with Yashu and me. And then I think we have a chat a week after that or something already scheduled for a Bloomberg reporter or analyst on the metaverse and Roblox. And we're going to pick his brain a lot on Roblox and such and that, and hopefully get some good insight on that interview. So we're hoping to do a recorded interview like once a week or so and release it on our channel for extra content.
Yeah, we've got, I do think we've got a pretty good lineup coming of people that I think we can always learn some stuff from people. I learn a lot from people that I don't agree 100% with, and I think Taylor falls in that category. I think a lot of people just think he's, this crazy, like, former bull that, just likes to dunk on Tesla whenever he can. But I think there's more to him than that. I've had a conversation with him in the past, and I certainly don't agree with him on everything, but I think his take is really interesting, especially his take on some of the stuff happening in China, which I think,
he seems to have a lot of insight on that.
We have a strong U.S. bias here just based on, kind of where we are. But China's doing some really interesting things in the EV space in particular. So excited to kind of get his take on that as well as, talking on some of the stuff on FSD and his, counterpoints to some of our thoughts on that. I think it helps us to just be better rounded investors when we can, listen with an open mind to other points of view. So yeah, excited to have that conversation with Taylor. Should probably post that. It should be up by this weekend, I think.
Yeah, absolutely. Yeah, I'd love to get a chat going with other, he's not like a full bear or anything, but I'd love to find some, legitimate Tesla bears to talk and have an open discourse with. Maybe we can get Beth Kindig on here or something one day. I'd love to have a chat with her and see what she thinks about Tesla in more detail. So
what about Gordon Johnson? Do you think you could stomach a Gordon Johnson interview? Or that'd be too much
tough.
shouting?
I think for that one we need a moderator, because I remember I listened to his interview with Rob Maurer, who's very polite, but Gordon Johnson interrupts a lot and overtalks him, and so you need someone like to really strictly monitor and say, all right, you get 30 seconds and mute them, and then you get 30 seconds to mute them. I think if you have someone like that, you need
do like around the horn where there's actually the mute button, and
you need something like that for
wins
someone
at the end.
Yeah, for someone that's used to overtalking people, you need that.
Yeah, no, I think you're right. Yeah, that Rob Maurer interview was kind of painful to watch. I mean, he just railroaded him a little bit. So
yeah. All right. Well, good chatting with you, Matt, and we'll miss you next week. But we have an interview coming up, and hopefully everyone on here got something out of this, and looking forward to keeping this going.
Yeah, thanks everyone.